Hi everyone, thanks for tuning into my channel. This is Sandeep. Most often ignored subject in the process of investing is asset allocation and diversification. Today I'm going to talk about asset allocation. Often people think that finding that next big winner stock is behind every wealth creation, which is certainly not the case. It could be a factor, yes. Picking the right stocks is very important in your portfolio. But really the returns is driven by one single most important factor, which is asset allocation, the percentage of allocation within the portfolio towards winners, where you water the flowers, and less number towards the losers, where you cut the weeds, is a very critical factor in the process of investing as well as to create a safe and sound portfolio. Diversification across geographies is very key, across sectors is key, across growth versus value is key. All are key in terms of portfolio construct. But at the same time, the percentage of allocation is very important factor. Imagine a situation where you have 10 folks in a room, 10 investors in a room, and they are choosing to invest in the same model portfolio of, say, 20 stocks. But their returns can be staggeringly different between negative returns all the way up to multi bagger returns just within the same portfolio by allocating different proportions to different stocks. Because all 10 might not have the same allocations or percentage of allocations in towards the stocks. Some of the folks might have invested heavily and maybe lucky enough to have more winners, and some people might have very heavy allocation towards one particular stock that became a multi-bagger. Few of the folks in the room might have allocated heavily towards the laggards, and some might have just done an equal distribution of 10% across or 5% across 20 stocks. Whatever said and done, the returns are going to be extremely varying for these 10 folks or 10 investors within the room who chose the same model portfolio. So imagine it is not the stock picking alone that is going to drive the returns. It's a percentage allocation and risk management, which is going to create a safe and sound portfolio. I have constructed a portfolio similar to that aspect. I wouldn't say it's perfect. I have given an attempt to create a well diversified portfolio, which is balanced in terms of growth and value, and also have distributed across geographies based on some fundamental analysis. And I've also associated videos across each of those investment thesis or the premise on which I constructed that portfolio. I have published it in sandcompounding.com. You are free to go and check out that portfolio and you can read it at your leisure. But here is a quick analysis. I wanted to walk you through that portfolio on what premise I constructed it and how to allocate within that model portfolio, which could help achieve greater returns. Take a look. So asset allocation is everything. So let's assume two people, person X and person Y. They start with the same amount, say 100,000 each, and person X is investing in three stocks, stock ABC, and person Y is also investing in the same three stocks, stock ABC. Now there is absolutely no difference. Same starting amount, same three stocks, but person X is investing in stock A 50 percentage allocation, stock B 30 percentage allocation, and stock C 20 percentage allocation. So which means the person X would invest 50K in stock A, 30K in stock B, and 20K in stock C. Now person Y invest 100K in, the distribution is 30% in stock A, 40% in stock B, 30% in stock C. Not much of difference between the way they are allocating. So you can see that person X is allocating, little higher in stock A, and others are almost same. Whereas person Y is uniformly distributing and slightly higher in stock B. Now, what has happened is, let's assume that in 5 years' time or whatever, 3 years' time, stock A has returned 100%, which means it has doubled in this 5 years. Stock B has returned just 20% on top of the initial capital. Stock C has returned a negative 40%, which means that the stock C has lost 40% of its value. Now, in such a scenario, the person X would end up having 148K in this kind of a distribution, which means has got a 48% returns in 5 years. Person Y would have a total of 126K for against the initial 100K capital. So which means the person Y would have 26% returns. Now look at this staggering difference. Person Y is having 26% and person X is having almost double the returns in just 5 years time with a simple 10% difference in the allocation between stock A and B. and see. So, it is just 10% here and there can make us such a difference. This is why asset allocation is so important. Now, let me take you through how to build a right asset allocation strategy and how to diversify well balanced to create a well balanced fund. Now, let me introduce you to my website. By the way, this is sandcompounding.com. This is my blog, and it has my podcast and everything, and it's a free website anybody can access. So there is something called as a model portfolio I created just for the purpose of illustrative purpose of how to build a portfolio which is well diversified, which is well kind of well balanced in terms of asset allocation. And just for your information, this portfolio has returned almost 60 percentage in 2020 alone this year, starting January, for the first 8 months, 7.5 months. And when I was taking this video, I just calculated to see how this portfolio is faring before publicizing this, and to be transparent. Now, this is my website. Anybody can go here and just subscribe. Subscription is free. I mean, I just created that to have some control in terms of access, nothing else. So anybody can just create a user ID and just view the portfolio. Now I'm going to walk you through the portfolio. You can see the portfolio here, and so this is SAN 20 for 2030. That's the title I'd given. It means businesses to have for next decade. And honestly, this returns is a lot supported by the current tailwinds. When I took this video when I created this portfolio in January 2020, start of the year, there were no pandemic. I mean, I seldom knew that this portfolio would turn out to be having such a tailwind, honestly speaking. But the idea is now here to talk about why asset allocation is important. So let me go there. Now, so when I say businesses for the next decade, you really need to think of creating a portfolio that has a concept of growth as well as some value. That's what I initially said in the video. And it should be a balance of both, which can compound over long periods of time. So we really need to look at businesses for the future, which can have a longevity. So I've written it here when I created this. The investors often undermine the importance of longevity of the businesses globally and give all their efforts to find investments which are cheap always, from the prism of a value investor, which is not bad. I mean, we need to have the prism of a value investor, but not entire portfolio should be completely comprised of pure value. You should have a balance of growth, value, earnings power, and all of that. So that's how I created this asset allocation portfolio. And I'm only talking about equity allocation. I'm not talking about the outside equity purview of, you should also have outside equity purview of bonds, golds, and all. But if you have, say, 50, 60% of your equity allocation, how will you do a global portfolio? And from a tracking point of view, I put the market cap as of Jan 2020 when I created this. And just a disclaimer I put, these are just for an illustrative analysis purpose, just to indicate how a model portfolio can be created, so you can follow in a similar path and create your own model portfolio or your own portfolio. So here is the SAN 20 for 2030 list, which I created, which has the market caps as of that day when I created. And in a tabularized view, I put the current market cap when I'm recording this video, how it stands. You could see the returns and the stocks that I created. My focus was to have, when I said growth, it was about 4 to 5 trends which are going to exist in the next decade, which is going to rule the roost next decade, which includes e-commerce, we all know, and it has a global diversification. So you can see stocks from China, US, Canada, India, Brazil. And you can also see this is Proceus is a listed firm in Amsterdam. It's a holding firm of Naspers, which is an investment firm. Then Mercado is a stock. It's a leading e-commerce giant and payments giant in Brazil. You can see MasterCard, because I chose MasterCard primarily for the Europe part, because MasterCard is tying with almost all the digital banks in Europe. Digital banking is the future. Open API, open banking is leading the way in Europe. There are a lot of challenger banks. And one thing to notice common was MasterCard was partnering with every challenger bank and digital banks in Europe. And you can see Indian bank, HDFC Bank. You can see Chinese e-commerce giant, we all know, Alibaba. Shopify wasn't this big at that time. It was just $46 billion when I created that portfolio. And it's a e-commerce, democratizing e-commerce retail for that matter. And you have some other Indian stocks, some Ferrari. We all know Ferrari, they have a strong moat. Then there is payments. So the other trend other than e-commerce was payments, which is going to completely transformed the way we do transactions. Everything is moving online. Digital transactions are prominent nowadays. In the next decade, it will be even more pronounced. And precisely why I picked payments, you can see, PayPal, and then Pinduoduo, another e-commerce brilliant strategic company who's ruling a lot and growing like anything uh, in China. And then Trade Desk is a media company. So you need to diversify across sectors, across different types of businesses. So I was more bullish on AWS cloud more than Amazon, but it turned out to be the other way. That's why you cannot predict the future. Amazon is doing really well in terms of the e-commerce business due to the pandemic nature, but I was more bullish on their cloud business 10 years from now. And I was hoping that they will spin off the cloud. Jumia is an African e-commerce leader. They did have some management issues, but they've done well in this terms of stock returns. And then there is Britannia Industries, which is an Indian consumer FMCG business, fast-moving consumer goods business. You can call it almost like it's more of a monopoly in the packaged goods in India, packaged business, and especially biscuits as their focus, and a lot of packaged good food items. And they have been doing pretty okay. Nvidia is a chip company. We all know it's a gaming leader, and data center operations of cloud has been. That was my thesis when I invested in this. CRISPR Therapeutics, you can see, is a healthcare company. It's primarily in biotechnology. We can see how biotechnology is really changing the paradigm of therapeutics, and we have Moderna and all of those companies doing well. And then there is Titan company, which is a leader in jewelry, gold jewelry. I was more bullish on gold. I was playing through a retailing game, which is a very strong play in India. Gold is maximum consumed in India globally, so that's why I preferred that. But the stock didn't do well at all, even though gold did really well because of valuation. And but this was not created for 1 year or 8 months. It is a 10-year story. So we need to really see how they do in 10 years. Tesla, electric vehicles, and the whole battery, renewable energy, and how that play is going to happen. And I didn't really anticipate the EV segment to take off like this in terms of stock returns in this year when I chose a portfolio. I was anticipating Tesla to do well over the next 10 years. And we saw the market cap just took off. I think it's even bigger than this right now. When we have last 3-4 weeks, it has gone up almost double from here in this position, right? So the returns would be even more now when I take a tab at it. And Viva Systems, again, a healthcare cloud play. They have a monopoly in that healthcare cloud. They are the only player in healthcare cloud. And so it's a broad diversification across sectors, payments, e-commerce. Then there is Sherwin-Williams, the typical paint company, has been compounding really well over. It's one of the strongest returns over the last 15-20 years. It's a great company, again, strong moat, only one of the, it has maximum market share and globally. So this is how you distribute the allocation in terms of equities. You have to have a global play, different continents, different countries, different types of businesses. And not to say the least, you need to distribute it equally in such a portfolio, not go heavy on certain things. If you have a very strong conviction, you can increase slightly, like instead of a 5% and in these 20 stocks, you could have maybe 8-10% in one of the stocks which you're super bullish on for 10 years from now, like Tesla, maybe, for example. That could lean towards the needle towards a very high returns, even more than this. So look at the returns, has been staggering in this year. Tesla 95%, Viva 87%, CRISPR 94%. So overall, Pinduoduo 117%, PayPal 77%. Some laggards are there. Bajaj Finance minus 25% because India got a lot hit during the pandemic, and valuations were crazy at that time for all these companies. I mean, all these our market leaders. HDFC Bank has negative 32% in returns, and Shopify 160%. So it's digital acceleration to the digital world has caused all these e-commerce payments players and all take off. And honestly, as I said, I didn't anticipate to have such kind of tremendous returns in the last 8 months to get a returns of almost doubling the portfolio. I think it's more than 60% now if you take a tab at it. And I had created a video for each of this, which I recorded in January. You can go through these videos also to see the rationale behind each of the investing ideas. And it's all in my channel. Also, I had created a playlist of 20
videos for each of this stock on thesis of why I invested. Each one is around 15-20 minutes. So really want to know how to analyze stock, it could be a good placeholder there. So this is the overall SAN 20 for 2030 list. I might have some tweaks here, some pruning here, when I have changes of the portfolio. But the idea is just to create a model portfolio, how guiding people on how to create. This is not a recommendation, or somebody doesn't have to follow exactly the same. If there are better stock ideas that could even return better. So this is how it has fared, and it is a good idea to have like 70 percentage allocation in equities and at least 5-10% in between gold, bonds, and all. Having some cash always help when the market downturn happens, like the happened in March 2020. We can invest more systematically in such downturns in these kind of quality businesses. If it's say if a business is priced very high and we can't invest at this point, it's a good idea to put a placeholder and watch it in the watch list. When the market falls, have some cash. Having some cash helps to plow it in such kind of stocks. This is how you typically invest and have a good wise allocation in between the equities and other asset classes. Globally, you should have diversification to avoid the country risk, which will help to create this safe and sound portfolio that I'm talking about. Thanks for staying with me if you're still with me, and hope this was helpful. Do subscribe to the channel if you like many such investing videos. Thank you.